You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, inflation has been in the news lately. The government's admitting to 7.5% inflation. No matter how you cut it, this is the worst inflation that the country, the world has encountered in the past 40 plus years. And many of you basically weren't alive or were in diapers at the time, don't remember the last bout of inflation. But I remember it, and hey, you didn't have to live through it to understand it and to understand what it does to your investments. Of course, it's only one factor, and we've got somebody here can help guide you through the landmines that are out there, the investing landmines, and interest rates, inflation, the Fed, all these things. His name is David Stryzewski. David, you are CEO of Sound Planning Group. You've been out there for more than a decade being a retiree Sherpa, and you've got a lot of awards that you've earned over the years. So we're in this situation now where you listed 5 factors. 2 of them are kind of jumping out at me now: inflation and geopolitical events, but that's not the whole picture, is it?
Right. No, hey, thank you so much for the opportunity to be here. No, there's 5 things that we're specifically looking at as it relates to what are the factors that will move the market. So yeah, just as you named it, interest rates today are a really big deal. Inflation, serious conversation to be had right now. What the Fed's doing in these rate hikes, really important for us to be paying attention to. Corporate earnings coming out of COVID. Now we're finding ourselves in sort of this new world. And then lastly, geopolitical situations, which was really heavily dominated by COVID in the past. And now we're looking at more Ukraine, Russia, and the various tensions that are going on around the globe. But the average consumer today is who our firm tends to work with. And we tend to work with people that are entering or nearing retirement, which represents a really unique time in their life, because they're going from we've got money coming in from work. We've got all these, we're budgeting where it goes. And we've been told to just save, don't look at those numbers. And now we're told, draw these dollars in. And what a lot of people have found is that they were planning for a fixed income that had a pretty low inflation rate. Why? Because we've seen inflation be so low, literally, for the last multiple decades. Our short-term memories here about how life works and how mortgages work and real rates are not really consistent with what has been historically accurate. And so we are kind of coming out of a time frame here where actually for the last 40 years, we've been reducing interest rates at the Treasury level. And that's a really big deal because it's given the ability for bonds to go on sale. And we've made a ton of money in bonds. But now as the Fed is reducing its balance sheet, raising these interest rates, we find ourselves in a really, really, really challenging situation for that average consumer. So what they're having a problem with, of course, is, hey, price at the pump, price at the grocery store. Where do we get yield when banks pay us 0.01 nothing? Our bonds pay us very little. And by the way, we've got an inversion right now in the bond yield curve, which we could talk about in a minute as an indicator of recession. And so there's a lot of concern, a lot of worry. Where do we go? What do we do? And I feel like that's where a lot of people find themselves today.
All right. So you've covered a lot of issues there that are of extreme importance to you as an investor. And what do you think the most important factor is that we're looking at now that you have to be most aware of?
Well, I'd say that it all starts as a personal, initiatives. There's a lot of things in this world we cannot control. We can't control when the market's going to go up or down, how long it's down, how far it goes down. None of that's controllable. We can't control what the Fed's going to do, where we find ourselves geopolitically, globally, in an interest rate market. There's a lot of change that's going to be taking place. I think that this is an important time for people to actually sit down and actually take an account of where they are. And one of the ways that we do that, and this is different because times are getting a little bit tighter now. With inflation going up, it stretches our dollar and our buying power. We've had 2 years, by the way, of over 7% inflation. So this doesn't just start with Russia recently. This has been going on for a while. Gas prices have been up for a long time now. And so what people need to be doing is sitting down and actually reviewing their budgets. And I know that that's kind of a swear word sometimes in people's households. They're like, a budget, I don't want to do that. One of the things that we've done is we've actually created a tool for those that are interested at myretirement.tips. And this gives you a personal retirement profile, gives you the ability to just kind of see your finances. It's more encrypted than Bank of America. My tech people know all the information. Here's the point. It can draw all your information and what's coming in, what's going out. It can collaborate all the different accounts that you have. We need to identify what is our risk today? What type of risk are we taking? Where are we invested and why? If you don't recognize that the world is changing right now as an individual investor, man, we really have to be paying attention or forever hold our peace. As things change, we should be actively evaluating and adjusting these things based on those 5 factors I mentioned before, but in light of our personal situation and how we need to organize our affairs in such a way that ultimately we can go forward with as much confidence as possible into this new world, which is a little bit bleak right now.
Yeah, it is a little bit bleak. But as my former law partner used to say, Kerry, the situation is hopeless, but never serious.
I like that.
And so when you're making a strategy, and obviously you don't know how long inflation is going to last. These inflationary waves can go on for a couple of decades, 2-3 decades, even more. Really, when you go from the post-World War II era, then we had a lulling of inflation, but then the Vietnam War, guns and butter, and it lasted really from the early 50s to early 1980s. That was a 30-year wave. Now, it wasn't all double-digit inflation, but it was higher than the norm. And just like for the past 40 years, we had below normal inflation. Sometimes prices didn't go up. The thing that I look at, the indicator that I have found to be most instructive for how inflation really strikes Joe Sixpack or Steve Chardonnay is the cost of a Thanksgiving dinner. And last year it was up in double digits, and this year it's going to be even higher. Those things are real, but rents are up, housing costs are up, interest rates going up. Does everything just keep going up, or do we really, the only way that the Fed can really contain inflation now is to effectively crash the global economy? They don't have a lot of choices here, do they?
No, I don't think that they actually have a playbook right now for where they find themselves. There's no way that you can have 40-year record low inflation and then be reducing interest rates on the Treasury for 40 years, creating these bubbles that I think that we see right now in our economy. I believe that there's a bubble in the housing market, a bubble in the bond market, a bubble in the stock market. And we see right now record deficit spending. We ended the year 2019, just as COVID was starting, with about 22 trillion in debt. Took our nation almost 230 years to get there. All right. But within 2 years and 1 month, by February of 22 this year, guess what? We hit 30 trillion in debt. We added $8 trillion in a matter of 2 years, 1 month. This is part of the challenge right now as we continue to pass additional bills and everything else. That's actually going to fuel the inflation market. And I'll be really candid with you. My bigger concern is not just inflation, but a concept called stagflation, which is not commonly understood in the average investor. And what stagflation is that we've got a stagnant economy. Our GDP isn't able to do as well, maybe because we don't have enough supplies, or there's brand new COVID restrictions right now in China. And Apple iPhones don't come in, and Toyota trucks and Samsung products don't come in any longer because those were the specific sections that are shut down currently. When we see a lot of this supply chain challenge, it has the exact same thing or effect as a slowing of our GDP because we just can't sell enough. We just can't get enough out there. And so if we see inflation, but then we also see our slowing economy, that means that less jobs. that right there, that's the hard one to come out of. And Volcker had to get us out of that. And it was through very, very meaningful interest rate increases on the Fed level that was able to stop it. But just like you said, this could crash our global economy. Well, the US dollar has been that petrodollar, has been that leader, that safe place to go. And of course, that's even being threatened right now as Saudi Arabia, I think the Wall Street Journal said on March 15th, here just a few weeks ago, that Saudi Arabia is actually entertaining a basket of currencies or the Chinese yen as opposed to just the US dollar straight up. And that right there is probably one of the bigger risks that we have, is losing that world reserve currency status. So many different factors taking place today. We do find ourselves at a moment where I think in the short term, hey, we're seeing a little bit of a bull market in the stock market. And we think that that's smart. We think that there's ways to make money here today, and also in sideways markets. We just need to be aware and know that our strategies are right for the times that are ahead.
And in definition of stagflation, this comes from Forbes magazine, is when you have high inflation, high unemployment, and slow or negative real economic growth. But we don't have high unemployment right now, at least if you're to believe the government numbers, maybe in large part because in my generation, we have this thing, the Great Resignation, where so many of you boomers out there just went through the pandemic and just said, lost your jobs, whatever. And you just said, I'm ready to retire. And that bodes poorly for the deficit and for economic growth. So maybe we've got lower unemployment right now because of so many people leaving the job market, and stagflation could be here already.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
No, it very well could be. And again, these are factors that are coming in ways that I don't know that we've seen them before. And, another one that's kind of a big deal is semiconductor chips and our lack of those things, or the lack of what we produce here in the United States. We've essentially outsourced, and that's a part of what that American dollar as the world reserve currency has given us the ability to do. And so, yes, the situation that we find ourselves in right now, we could be in a stagflationary environment. I think that's very, very probable. And so that acts and the solutions are a little bit different than if we were in just an inflation only environment. And so these are things that we need to be watchful for. We need to be mindful for. But if we all can't buy the exact, there's like a handful of cars at a car lot today. Just drive by them. It's remarkable, right? Have you ever seen that in your lifetime?
No, I was driving through Fort Lauderdale, Florida, and a friend of mine who'd been in the car business was in the car with me, and she pointed over and said, what is that over there? I said, that's a Toyota dealership. And we looked, the lot was completely empty. And I can remember this, one of the largest Toyota dealers in the country, being packed to the gills with vehicles, and now there's nothing there. So these types of things kind of really hammer home, David, what you're talking about in terms of you're losing purchasing power, but you're not just losing it because the value of the dollar is going down. You are losing purchasing power when you can't purchase products and services that you would otherwise be able to because they don't exist.
Right. Yeah. Even Ford right now, I saw a report where there was like a picture from space of all the trucks that they have sitting right now, not able to be completed. because they don't have enough semiconductors or computer chips to fulfill the truck's order. There's about 3,000 in the average car today. And what was interesting is that, how many of these semiconductors can you not have in order to, make sure that you keep going with the car? Well, the challenge is that you can't put the eggs into the cake after it's been baked or take them out. You have to do them sequentially along the way. One of them not being in place caused the whole thing to not be in there. And so we're seeing maybe most of the supply there, but the supply chain is damaged, and the ability to get full service on some of these items that need to be outsourced from many different places, or have been outsourced, I should say, from many different places. We have a challenge in getting now the product to the lot. And so I feel like we're real close on a whole bunch of stuff, but we're not exactly there. And so there's some new issues to be figuring out. And I think that corporations are really obviously working on this. The average consumer is, I don't know if they're really paying attention to it right now. I think we're starting to. I think that we feel that price at the pump. We feel that price at the grocery store. We see, as it starts getting warmer, the price of steaks and meat have gone up so significantly. If you're trying to do any real estate deals right now, the prices of everything have gone over the top. And so we are in a moment where the average person is looking for advice. They're looking for information. And I think this is the time that they really need to be finding it. So sit down, take a Saturday, take some time, think about and review who is the team that you're working with, and are they providing you the right resources? Have we evaluated things from the standpoint of taxation, from risk management, from time horizons, from liquidity needs? It's okay to be liquid. One of the things that we want to do right now is we want to be more dynamic and some of our money management models. So we're being more idiosyncratic or singular in our focus. We're going to be more individual stock basis. Why? Because there's certain players that are positioned to do well amongst their peers. And, if we can find those opportunities and those at-bats in a good way, we're going to just endeavor to rotate towards those things. We also want to do commodities. It's not just about owning gold and silver straight up. It's about having an understanding of what's going on with the metals market. So we have a metals portfolio as an example that is absolutely rocked and way outperformed what metals have done this year, which is essentially net nothing. And we're way more than double digits, specifically in that portfolio. And so the point is that there's ways of making money in this economy. You just need to understand where the ebbs and flows are, where traction might be, why you would want to avoid bonds right now, specifically long duration bonds. I cannot think of a worse investment personally. And what we're seeing is a lot of investors right now are selling those positions and they're going short duration, which is why we've got this inverted yield curve. So where the short term, the 2 and the 10 are inverted and the 5 and the 30 right now, meaning that those shorter investments are paying more than the longer ones. And those have been literally the most accurate indicator, at least in the last 8 recessions, that we will have a recession within the next 12 to 18 months. Hey. So where do we go? What do we do? How do we do it? How do we manage those volatile positions and those times? That is the question that we will all have to answer.
And that is a great question. Another indicator is that whenever the unemployment rate is hit 3.6%, we get a recession. Mm-hmm. So you got those two factors combined make a very persuasive case. And then, David, if we got a recession coming, that the Fed is going to abandon their higher interest rate policy. Right now, that's their story and they're sticking to it. But a couple of quarters of negative GDP growth or some more explosive world situations, that changes quickly, doesn't it?
Big time. And I think that what you'll probably see is instead of the quarter point increases that they've been talking about, they're probably going to do more like 0.5% increases. And I think that they'll do those because if they know that their time frame for grace in the economic health, and while things still feel good and the climate's still right, they're going to try to shock the system a little bit. The market's already metabolizing the fact that there's going to be, I heard Goldman Sachs yesterday say 11 rate increases in the next 24 months. So you're right. If we get a downturn, it's not likely that the Fed's going to keep that same trajectory. So I think they're going to do more in the short term, which really is going to cause an interesting thing to happen with mortgage rates. It's interesting. It's going to happen is a big bear market in bonds because it's a seesaw effect. Interest rates up, value bonds down. People don't know that. And they just hold the bonds. In fact, there's a lot of people that have high yield bonds, which is an interesting term. That's like putting lipstick on a pig. Those are junk bonds, less creditworthy companies. And they don't understand that they could, or they have much higher insolvency risks. And so I think that as we look at creditworthiness and we see various companies maybe going from really strong to potentially weaker, given some of these challenges, this is a very, very important moment in our nation's history to be paying attention. Because if we're not, we just go sleep at the wheel thinking everything's cool. We are not in 2013 anymore. We are not in 2019 anymore. We are in 2022. And as we look back at the world, we look back where we've been, we need to have an understanding for where we're going into the future here. And so I'm not a doomsdayer, but man, I'm a realist. And I think that there's some very, very real things that are showing up right now that people need to be paying attention to. I think they are. The question is, where are they going to find the information? They know the Thanksgiving dinner is getting more expensive, like you said, but where do we go?
And hey, you almost sound like you've been watching Financial Survival Network with your past comments there. So, hey, we appreciate that. But so obviously uncertainty is going to rule. It is possible that the Fed will get in a couple of rate hikes, maybe 100 basis points in total before they're going to start reversing. But they're going to have to reverse because the deficit, all these things got to be paid for, and there's no money to pay for them. Not to mention, David, my generation, the baby boomers, are retiring more and more every day. Hey, the thoughts even crossed my mind a couple of times. I'm not quite there yet, but many of you will be, especially if employment opportunities dry up and the Social Security is just waiting to be taken. Hey, so I know you help people kind of navigate these minefields. David, how can you be reached? How do we connect with you on the web?
Great question. Well, I think that website I mentioned before is a great place to begin, myretirement.tips. That I'm going to just give people a free financial dashboard, the ability to kind of check in. myspg.com. Sound Planning Group is our company. myspg.com is our website. You can look into us, see great things. I actually teach a number of classes on college campuses here throughout the greater Seattle area. That is going to be turned into a online university. Just talking about topics like income planning, investment, taxation, Medicare, long-term care. That's the healthcare side of our strategy. Real estate, estate planning. What we're trying to do in putting together comprehensive plans. And so, for those that are interested and they would like to have a conversation, learn some more, happy to share more details. They can get a hold of us through those various metrics and means. And one of my team members would be happy to assist and have some conversations there. All
right, excellent. Hey, if you got a question for David, just shoot me an email, kl@kerrylutz.com. We'll get you an answer. Don't forget, go over to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. David, thanks so much for coming on. A pleasure.
Kerry, thank you so much.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.